good morning, good afternoon, or good evening, depending on which part of the world you're catching us from. I'm Adam Khoo, and welcome to this webinar. Thank you for waiting. Thank you for taking the time to be here. And I believe that you're here because you're passionate about trading, and especially Forex trading. And you know that when you put your mind to it and you learn the right skills, you can create a pretty good income for yourself from the Forex markets and to build a Forex trading business that, again, it's a business you can run from anywhere in the world. It's pretty recession proof. So today I'm going to run through with you specifically how I analyze the markets daily with my community of traders from all around the world literally now, and how we identify high probability trades in the market. And again, how do we enter the trades and how do we exit the trades with profits and at times losses, and how do we generate consistent profits by doing this day in and day out. At the same time, I'll do my best to answer as many questions as I can. I've had quite a number of questions coming in already, so do send in your questions. I'll answer them in groups and in batches depending on the topics. And this is also your chance today to catch our Black Friday offer, which is one time you can get our courses at a huge discount. So stay to the end so you get this fantastic offer that's not going to be repeated, right? So just like the stock market, things are going to be really undervalued right now for you to grab these offers, okay? So I'm going to begin by running through some fundamentals. Some of you who have been following my videos, you would know some of my key fundamentals. We're just going to review it right now. So first and foremost, let's remember what makes a profitable trader. It's not someone who can predict the future. It's not someone who's born with some special talent. But to be profitable, there are three qualities that you can develop or you can have no matter who you are. And the first is you got to have a trading system that has been proven, okay? You need to have a trading system with a positive statistical expectancy in the markets. So what does it mean? It means that, in every trade you take, you can't predict where the market's going right now. No system can do that. There's no holy grail method that wins all the time, okay? So in any strategy, you will have wins and losses. But a good strategy is one where as you keep trading, you have a lot more wins than losses. And your average win is a lot bigger than your average loss. And that's what creates consistent profits over time. And yes, you can be profitable almost every month, right? Once you are experienced enough. And, it can take, for some people, a month, 3 months, 6 months, depending on how much you apply yourself. So again, I keep saying that, trading business is kind of like running a casino. And you're playing with the world out there, that the house always wins in the end. The casino always wins in the end because the casino has an edge over the players. Just like when you have a strategy, you have an edge over the markets. In any bet that people place in a casino, the casino could win or lose, right? It's random luck in the short term. Every trade that you make is random. The result is random on a trade by trade basis, just like spinning the roulette wheel. It's random, right? But over many trades, the casino will make money, just like you will make money if you have this strategy. So again, what's a trading system? A trading system is one where you have a specific set of entry and exit rules that are objective based on a sound methodology that gives you a statistical edge. So in other words, whenever you enter and exit the Forex markets, it must be based on a method that has been proven statistically to give you that edge in the markets. And again, I'm going to remind you what creates that edge in the markets, to be right more than we're wrong, basically, okay? Now, 90% of traders out there lose money or they don't make money consistently because they don't have a trading system. Or if they do, they don't follow the system consistently, all right? Most losing traders, they trade based on what? They are listening to the opinions of other people. Hey, the euro's going up, they go buy the euro. Hey, franc's going down, they sell the franc, all right? They trade based on emotions, like revenge trading, like greed trading, right? And they make predictions. I think it's going to go, I feel it's going to go up, right? Or they say, I'm lucky today. When you hear traders say things like, I was lucky today, I was unlucky today, I know it's going up, they're not making money, right? There's no way they can make money consistently because they don't have an edge. So in the long run, they will always lose money, even though they could make money once in a while. Well, that's gambling, right? So again, the focus is not on luck, on gambling. The focus is on building a sustainable trading business. So number one, you gotta have a trading system, okay? So your trading system has to give you an edge. I keep saying statistical edge means that over trades, you'll be right more than you're wrong versus flipping a coin and just being random, okay? So what gives us this edge in the markets? The first thing would be trend, okay? My mentor told me years ago that there are three things that you want to avoid going against. Number one, don't go against the power of love. Number two, don't go against gravity, right? Try jumping off a building without parachute, right? Number three, don't go against the trend of the market, right? So if you swim with the current, when you buy during an uptrend and you sell during a downtrend, right, half the battle is won. Okay, so we always want to do our best to trade with the trend. Trouble with most people is they want to pick tops and bottoms. As it's going up, they say, it's gone too high, I'm going to sell. And they say, I'm going to sell there. I see a bearish pin, I'm going to sell. And after they sell, it comes down a bit. Yes, it goes up, boom, hits their stop loss. They get stopped out, right? People like to catch bottoms, right? They say, oh, it's going down so much. It has to reverse, right? And then it reverses a bit over here. They say, it's going up, I'm going to buy, boom, they die, right? Because they're going against the trend. So do your best to follow the trend, number one. Number two is support and resistance. So support and resistance basically tell us where buyers and sellers are lining up. All right, so when you have a resistance, it means what? Supply stronger than demand. There are many sellers that are waiting there. So at a resistance level, price is more likely to reverse. Again, not 100%, but probably going to reverse than not. At the same time, a support is when there's more demand and supply, more buyers and sellers. Buyers are queuing up at support levels. So whenever the price goes to a support level, what happens? More likely is going to reverse back up, okay? So general rule, we want to avoid buying near resistance and selling near support, okay? So again, if you do that consistently, odds are in your favor, okay? The third thing would be moving averages. Moving averages are one of the most powerful tools that I use, that most traders use. So we use moving averages to define trends. So generally, on a very strong uptrend, what do you see? You see the moving averages sloping up. That's right. Can you see the sloping up? And you see the moving averages arranged in sequence from the smallest to the biggest moving average. So I like to use, for example, the 6 EMA, the 18 EMA, and the 50 EMA, and the 200 SMA, which you can't see over here. So when you see 6, 18, 50, 200, it's a very clear uptrend, right? Again, sloping up in that sequence. And also notice that on a very clear uptrend, the moving average acts as a dynamic support. So whenever the price retraces, give me a second, I'm just too trigger happy right now, right? Whenever the price retraces, it tends to find support at the moving averages like so. So those are a good indication of when the trend is going to continue after a minor retracement, right? So always remember, on an uptrend, you have got what we call the impulsive wave, which is the wave going up, the corrective wave, the wave coming back down, and the next impulsive wave, and that trend continues. All right, so the corrective wave usually ends at a support level like a moving average, okay? And again, opposite for shorts. All right, similarly, you can see over here's a downtrend, and again, you can see moving averages are sloping down and in the opposite sequence. So now the smallest moving average is below, the biggest is on top, right? So you've got 6, 18, 50, and 200, right? And again, on a downtrend, what happens? You've got impulsive wave, corrective wave, impulsive wave, corrective wave. And when it corrects, it tends to find, again, resistance at one of the moving averages, right? So this is a very important phenomenon to understand, okay? Next thing would be Fibonacci levels, right? Sometimes you can use Fibonacci to improve your odds. And what that basically means is that whenever the price moves from A to B, which again is what we call the impulsive wave, right? Imagine it's 100% move. It will tend to retrace to a Fibonacci level, like the 61.8% level, which is the most common Fibonacci level. okay, before continuing the next impulsive wave, right? So whenever it retraces to 61.8, gives us a lot more confidence that, hey, that's the end of the retracement wave. It's going to go higher. Again, sometimes it could retrace to the 50% or 61.8%, all right? So generally, what happens? These phenomenons basically allow us to exploit repeatable patterns in collective human psychology. All right, so these are patterns that repeat again and again, uptrends, downtrends, support risk. These are patterns, all right? And as long as we identify these patterns in collective human psychology and we trade these patterns consistently, it gives us that edge in the markets. Okay, great. So those are the fundamentals. So understanding that, all right, how do I analyze the markets every day with my community of traders? Okay, so every day when I open up my charts, oh, I've got some people asking, is this a live webinar? Yes, it's a live webinar. How can I prove it's a live webinar? Okay, I don't know. How do I prove it? Use my phone. Show them the time. Okay, some people say, is it a live webinar? It is. There you go. Here's the phone. Well, this is Singapore time, actually. There you go. Okay, that's the phone. It's live webinar. I'm here. This is not, what they call it, deep fake nowadays. You can put my face on someone's face or a porn star on my face, something like that. Okay, sorry. Okay, it's live. Anyway, so where was I? Okay, so like I said, so every day what happens is I load up my charts, and here's how I analyze the price action on the charts. Okay, so I'm going to show you right now. When you look at the charts, basically you must know when to trade. Okay, now understand that many times when you see the price, it's random. There's no pattern. And when that happens, you don't trade. Okay, so there are days or there are times in a day when it is not tradable. And many traders, they want to find a trade and they are really impatient. So even though the price action is choppy, they get into a trade and that's how they keep getting stopped out. All right. So remember, in trading, not doing something is doing something. There are days when I do not trade at all. There are sometimes even 3 days in a row, I do not take a single trade. Why? Because when I look at the price on the charts, it is not tradable. Okay. And I'll share with you what I mean by not tradable. Okay. Because the price is not moving in a pattern which I'm looking for. Okay. Now, so that's the first thing. Next, once you see a pattern, you must understand which strategy to trade when you see a particular pattern. Okay, so let me now go through that in greater detail. So first of all, when you look at a chart, okay, sometimes you will see something like this. Okay, and this is what I call choppy price action. Okay, so whenever I see price action like that, I don't bother trading that chart, that currency pair. Okay, so what is choppy price action? Now in choppy price action, notice the moving averages are not clearly sloping up. They're not clearly sloping down. They're kind of like crisscrossing each other. Can you see? It's like it crosses up, crosses down, right? So when you see this crisscross action, forget it. It's not tradable, okay? At the same time, notice that the candles do not respect the moving average. It breaks below the moving average. It breaks above the moving average. It doesn't respect it at all. So choppy action, move on to the next currency pair. Don't even bother trading it. Okay, so that's the first thing you may see. Next, the next pattern that you will realize that will happen at certain times, okay, is the currency pair is trending strongly. And it's trending strongly and bouncing off the 50 exponential moving average, okay? So when I see it do that, I begin to say, okay, which strategy do I use right now? And I'll use what I call the bounce or trend continuation entry strategy. All right, so these are two of my favorite strategies, the bounce strategy and the TCE strategy. And again, when do I use it? I use it when I see a currency pair trending and bouncing off the 50 EMA. Okay, so on my left is an example of an uptrend and it's bouncing off the 50. Can you see? Boom, 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 boom. There you go. Bouncing off the 50, and the 50 acts as a strong support. Okay, now again, does this happen all the time? No, it only happens maybe 10% of the time in the market. So these are the times when you want to trade using the bounce or TC, when the market, when the currency pair is showing this kind of price action, right? Now, the other thing to understand about support or resistance is that in a market, it's not like, you know, an exact line where it will exactly touch and bounce off. As you can see, sometimes the price will break below the support slightly. And if you place your stop loss too close below the support, guess what's going to happen? You're going to get stopped out by the market makers. You're going to force the price down below the moving average, hit all the stop losses, and then move higher. So if that has happened to you, it's for one reason only. You place your stop loss at where everyone places it. So you got to place a stop loss where no one else places it, where it's going to be really difficult to hit. You have to give buffer below a support or below a moving average, right? And I'll share with you more later on about where I place my stop losses for the bounce strategy that I use daily, right? Okay, on my right is the downtrend, all right? So again, this is the uptrend version, the downtrend version, and it's trending and bouncing off the 50 EMA. So can you see that? Boom, bounce off, boom, 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 boom. So the 50 acts as a strong resistance, okay? So again, once I see that pattern, what do? I look to use the bounce or TC strategy that works the best for the 50 EMA. All right, and I'll show you the entry and exit rules in a short while. Okay, so I've got a question right now, which what time frame am I using? Okay, now this can be the 15-minute time frame, 1-5 at a minimum. I do not trade anything in less than 15-minute time frame. So at least 15-minute time frame. You can also trade this on the hourly time frame, H1 time frame, or even the H4 time frame. Could you trade on the daily time frame? Yeah, you could, but to me that's a bit too long. All right, I don't have the patience to wait for a daily time frame. All right, so M15, H1, or H4. Now I primarily trade the 15-minute and the H1 time frame. Okay, next, the next pattern that you'll see is the currency pair is again trending strongly, but this time it's bouncing off the 18 EMA. Which is this light blue line. Can you see the light blue line? Okay, so the dark blue line is the 50, the light blue line is the 18. Okay, so again, on my left, you can see a clear uptrend where the moving averages are in sequence, right? So you've got the 18, you've got the 50, and then you've got the 200. So again, notice the pattern. The price is bouncing off the 18. There you go. There you go. Boom. Boom, 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 bouncing off the 18. There we go. All right. So once I see that pattern, I trade the TCE strategy only, not the bounce. I tend to trade the bounce strategy only for a 50 bounce. But if it's an 18 bounce, I tend to prefer the TCE strategy. So let me just do a very quick recap for you guys, right? So like I said, when you look at a chart or currency pairs every day, if you see choppy, don't trade, walk away, look for another currency pair. What I want to see is trending strongly. Okay, so again, the first version I'm looking at is trending and bouncing off the 50 moving average, either on an uptrend or on a downtrend. Then I look to trade it using the bounce or TCE strategy. Okay, the next pattern I look for is again trending, but this time bouncing off the 18 EMA. So again, this light blue line is the 18, that's the 50, that's the 200. So again, notice this is a trending pattern and it's bouncing off the 18. Boom, 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 boom. There we go. Okay, this downtrend version, trending, bouncing off the 18. Okay, so as a trader, you have to be patient to wait for this pattern to show itself. And again, on any given day, it could show itself on the dollar pairs, on the franc pairs, on the pound pairs. So we are always looking for currency pairs that show us this pattern, and then we trade using that particular strategy. So again, when it's bouncing off the 18 EMA, it's best to use the TCE strategy, known as the trend continuation entry strategy. Okay, And again, I'll talk more about it later on, which is the entry and exit rules. Now, finally, the final pattern that I see is what we call the surfing EMA pattern. Okay. Now, again, there's a difference between bouncing off the moving average and surfing the moving average. Here's the difference. So let's imagine this is a moving average. Bouncing would be like that. Doing, 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 doing. That's bouncing. All right. Surfing is when the price is hugging the moving average. Like this is what I call surfing. Check this out. Can you see that? It is literally hugging the moving average. I call it surfing the moving average. All right. Now, similarly, on a downtrend, what's bouncing? We saw, right? Boing, boing, boing. That's bouncing, right? But over here, you can see it's surfing, right? The price is surfing the moving average, it's hugging the moving average, okay? So sometimes it may surf the red line over here, and this happens to be my 6 EMA. Sometimes it may hug the 18 EMA. Sometimes, like over on this side, it's hugging the 6, it could hug the 18. So whenever I see this surfing pattern or this hug pattern, I use a strategy known as the bull flag or bear flag surfing strategy. Okay. So again, I'll talk more about that in a while. So just understand that every single day, I look at the markets with my community of traders, and we look for these patterns that exist, and we apply the strategy for that pattern. All right. So let me go into greater detail about the strategy. Okay. So the first strategy which I use is known as the bounce strategy or the EMA bounce setup. And again, when do I use this strategy? When I see the currency pair trending strongly, bouncing off the 50 moving average. Okay. So in this case, you can see that it's bouncing off the 50. Boom, boom, right? Boom, boom. It's bouncing off the 50 now. So some people ask me, hey, how many times must it bounce for you to say it's a pattern? Well, just once. That's right. So as long as it hits the 50 once, bounces off, I'm looking to buy at the second bounce. Okay. So in other words, now for this particular trade I'm showing you, by the time I saw it, I had missed this. I missed this, right? I was probably sleeping somewhere, right? So by the time I kind of like looked at the markets, it was somewhere here, and it was coming down. Okay, so as it was coming down, I noticed that, hey, it's coming towards the 50 moving average, and I anticipate it's going to bounce off the 50 moving average. And again, how do I know? Because I've seen that it was tested here. So again, as long as it's tested once, it's good enough for me. But notice in this case, it was tested once, twice, 3 times. So that's a really strong test. So I'm really confident that when it comes down, it's going to bounce. Okay. Now, the next thing is I want to see a clear uptrend pattern, which means higher highs and higher lows. So this recent swing high should be higher than the previous swing high, right? It makes higher highs. Can you see that? And this recent swing low must be higher than the previous swing low. So you got to have that higher high, higher low pattern, right? Okay. So now the price is coming down, coming down, coming down, coming down, coming down. It's going towards the 50. Now, so how do I enter? Well, there's a few ways of entering. I'm going to show you the laziest way of doing it. Okay. And it's to simply place a buy limit order at the 50 moving average, right? So in this case, my buy limit order is right at the moving average, which is 3262. So a limit order means as long as the price reaches 3262 or lower, it will trigger my order. Okay. So yeah, that's what I do. Okay. And now where do I place my stop loss? Again, remember what I told you earlier. When the price hits the moving average, it doesn't exactly bounce off. Sometimes it can go below the moving average, right? And people who place a stop loss too close, they get taken out. So I want to place my stop loss far enough that even if the price penetrates the moving average and kills most stop losses, it won't reach my stop loss. And then it goes all the way back up after screwing most people out there. All right, you want to get people get fucked first. Oh, sorry. You want people get screwed. Okay, anyway. So what I do is this. Now, when I enter over here, okay, I ideally want to take profit at the recent swing high or just above it, but not too far above it, right? So what I do is I roughly measure, okay, from here, if I buy here, okay, sorry. If I buy here, okay, I want to reach at least the recent swing high, or slightly higher is fine, because, you know, higher highs, higher lows, right? So I measure the distance. I say, okay, from here to here, for example, it's 38 pips. Okay, so in other words, my profit target is at least 38 pips, which means my stop loss can be half of that, right? So 38 divided by 2 is 19. Because again, when I'm trading, I ideally want to risk 1 to make 2, or 1 to make 1.5, at least 1 to 1.5. In fact, recently I've been actually taking 1 to 1.5, and my win rate has been really high, like 70% win rate. But if you take a 1:2, your win rate may drop to 60% win rate or 55% win rate. So recently, I kind of like a high win rate of 70% win rate, but 1:1.5. But it's really up to you, okay? So in that case, I know that I can place my stop loss about 19 pips below the moving average. So I've got a lot of room, all right? So if the price breaks below the moving average and kills people, I've got a lot of buffer, all right? So that's what I do. All right, so my buy order is there, my stop loss is there, my profit target is over there. All right. Now, the other thing which I do is, now in this case, I'm trading on the 15-minute time frame. All right. So I always look at one time frame higher. So what's higher than 15 minutes? 1 hour. Okay. So this is the 1 hour chart of that same setup. Okay. Now, I want to see that on the 1 hour chart, the moving averages are also in sequence, which is the 6, or in this case, the 18, the 50, and the 200. Okay. And I also want to ensure that my stop loss, which I've placed, is also below a strong support at the hourly time frame. So you can see over here, that's my entry. That's my stop loss, right? That's my profit target. Now notice that on the hourly time frame, right? This is hourly time frame. The price is bouncing off this blue line, which is the 18 moving average. Can you see that? And so notice that my stop loss is safely below the 18 moving average that is protecting my stop loss. Okay. So what's really important to understand is that on the 15-minute time frame, the price is bouncing off the 50. So my stop loss is below the 50, being protected by the 50. And on the hourly time frame, the price is bouncing off the 18 moving average, and my stop loss is below the 18. So in other words, your stop loss must be below a support level on multiple time frames. Okay, so that's what I mean. All right. All right. So in this case, what happens? I take the trade, and sure enough, the price comes down exactly to the 50 moving average, triggers my buy order, and 1, 2, 3, 4, 5. Within 5 candles, it hits my target price of 3300. Right. So this is how I set up a bounce trade. And again, notice for this one, I was trading the 50-minute candles and looking at H1 as a confirmation. I could also trade the H1 time frame and look at the H4 for confirmation. All right. So that's the bounce strategy. The other strategy which I use is known as the trend continuation entry, or TCE. And it's quite similar to the bounce strategy, as in, you know, we're looking at prices bouncing off the moving average. The only difference is that I look for a candlestick pattern, a trigger before entry. Okay. So in the previous example, I just bought the moment it hit the moving average. But for this strategy, I wait for a candlestick pattern to form at the moving average before entering. Okay. And both methods are very profitable, and they both have their pros and cons. All right. So there are times I like to use one. There's times I like to use the other one, depending. All right. I'll share more with you later on. So in this case, again, I'm looking at the 15-minute time frame. All right. And the price is bouncing off the 50. Can you see? Boing. And then it is hitting it here. Now, again, I mentioned before, I only need for it to be tested once. So this was the first test. It hit the 50, it tested it, it went up. Now again, is it making a higher high? Yes or no? Say yes. Okay. Is it making a higher low? That's right. So we need, again, higher highs and higher lows, right? Now this time as it comes down, what do? I wait for a candlestick pattern to tell me that it is reversing. So one of the ones I like is the bullish engulfing pattern. All right. So bullish engulfing pattern is where you have a small red candle and the body of the red candle is engulfed or swallowed by the body of a big green candle, right? Which means that bears have been eaten up by the bulls, right? So we're now very bullish. So that's a bullish engulfing pattern. So once I see that pattern, I place my buy entry just about 1 pip above the high of the bullish engulfing pattern. In this case, 3516. I place my stop loss slightly below the low of the bullish engulfing pattern, 3507. So in this case, it's a 9 pip stop loss. And in this case, I aim for 18 pips because again, if I'm risking 9, I go for 18. If I'm risking 20, I go for 40. So always risking 1 to make 2. Or like I said, recently, I've been actually risking 1 to make 1.5. All right, not so greedy now, but my win rate has been phenomenal, 70%. In fact, this month, my win rate is about 80% win rate, right? Risking 1 to make 1.5. But it's up to you. If you want to risk 1 to 2, that's fine as well. There are times when I still go for 1 to 2 when I see that the trend is really strong. Okay. All right, so that's the trend continuation. Okay, this is a short example, right? Going short. So again, going short, you can see it's bouncing off the 50 moving average. It was tested somewhere here. That's my bearish engulfing pattern. Okay, and again, price is making lower highs and lower lows. You want to see lower highs and lower lows. Once I see that bearish engulfing pattern, again, I put my sell entry just below the low of the candle, stop loss above the high. In this case, I'm risking 11 pips. So I need to target at least 22 pips in this case. That's my profit target over there. And again, I'm trading on 50-minute candles, so I look for H1 as a confirmation that everything's aligned as well, right? So always align multiple time frames, really important. Okay, now, a question that people have for me would be, Adam, there are so many currency pairs, right? How do you scan the markets? How do you have like an alert system and all those things? And the answer is yes. My alert system are my fellow traders, our community. So as you know, we now have a community of about 400 traders in our chat groups where we're chatting literally 24 hours because we've got people from the US, from the UK, from Maldives, Kuwait, Singapore, Saudi Arabia, and it's round the clock. So there are 400 of us, and whenever we are free, we watch the markets. Whenever we see a setup, we alert each other. Okay, and that's our alert, which is each other, right? So the moment someone posts an alert, how do we look for trades every day? Basically, we've got a trading community of about 400 traders and all around the world. So whenever we are free, we look at the markets and we alert each other, every single day. In fact, if I open up my Telegram chat group, let me just show you where is it right now. Yeah, you can see, they are all trading right now. In fact, they are actually watching this webinar as well. So they're kind of like giving me comments over here. So I'm going to show you some of the trade calls they made in the last few days. And we'll analyze the trades together. And then I'll do a live, I'll go into the markets live right now and see, are there any trades to take right now, right? If they are, we can take them. If they aren't, then there's nothing to trade. So let's take a look. If you like this video, do click the subscribe button for more videos. If you'd like to find out about online professional Forex and stock trading courses, do visit piranhaprofits.com for international students. And for our students in Asia, we have our live stock trading and investing courses at wealthacademyglobal.com. This is Adam Khoo signing off. May the markets be with you.